Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So before we get started, just want to highlight that we're going to be at 4,000 subs soon. Can you feel the excitement? Can you feel the energy? I'm really excited. You know what was the most exciting time for me in this channel? When I got my first like 10 subs. I was like, people want to subscribe to this channel. I can't believe it. And then once I started making $300 a month, my at least a month for just doing these spreadsheets, my mind was blown. You want to make some money? Just copy, do what I do, and then just have a little bit of fun at it. So what are we doing today? We're gonna do velocity banking. We're gonna just do another velocity banking review. And you know what would be so awesome if I had a velocity banking, I don't want to say boot camp, but maybe like a nature camp or a study camp, right? Velocity banking. Easy debt payoff camp, right? We go to the wilderness in the woods and the trees are full of money. Okay. The trees are full of money. And then we got these camp counselors. They give us a notebook with Excel, some real life case studies. We solve our debts and then we go home even richer. Is that even a word, richer, or is it more rich? I don't even know. Okay. So that's what we're going to do here today. And I'm going to tell you for sure, I probably would have hated a velocity banking boot camp as a kid, but your taste change as an adult. Like whatever you hate as a kid, you kind of like as an adult, vice versa, right? I love candy as a kid, can't stand it as an adult, right? All right, so let's go ahead and get started. So we're another velocity banking review for today. So what is velocity banking? All it is a debt payoff strategy where you throw all your money into debt with the help of a line of credit, right? And we call our line of credit as our main operating account. And you know what the difference between the average American and the velocity banker is the main operating account. See, the average American, they pay for things with their checking account. They have all this debt, they segregate their income. What does that mean? They just kind of pay the minimums on every single debt, and they pay for their food, gas, insurance, and then whatever's left over, they leave in their savings. Okay, that's what we mean when we pay for our things with our checking account or making our main operating account. Now, what we're gonna do, okay, what we're gonna do is we're gonna make our main operating account as our line of credit. All right. So when we do the velocity banking side of things, it's so easy, right? I just copy the same income and expenses, right? But here's the crazy part that most people have trouble with is I'm not going to have any savings because I'm going to actively put all my money into debt. It's that easy, okay? But here's the thing. When we started this start, we're at negative $50. So there ain't no way that we're going to be um doing fine when we're at negative savings, right? Negative $50. Because what happens when we have negative savings? The bank charges us an overdraft fee. So that's probably an extra negative $30 in our savings account. Now I don't know if you knew this or not, but banks make billions of dollars off of those overdraft fees. I remember when I joined my one of my first credit new bank accounts, right, from a credit union. They didn't have any overdraft. I was like, "They don't have any overdraft protection?" Got hit with the $27 bill. I was like, "Whoa, that's insane." Now, luckily, if you call them, they'll forgive it like once, I think. So that happened to me, but I was like, $27 and they didn't do anything? That's insane. So you gotta be careful. We don't want to be in this position. Now, what we're gonna do is make an assumption that we have access to a line of credit. And because I like to cheat, I always like to assume that we have access to the amount that we have in credit cards. So how much do we have in credit cards? 27, 35, 18. And so let's sum it up. So we have $80,000 in credit cards, okay? $80,000. So this is what we're going to do. We're going to assume we have maybe an $85,000 line of credit. So what's a line of credit? All it is a financial tool where you can borrow money, pay it back, and use it over and over again, just like a credit card. But unlike a credit card, which is technically a type of line of credit, we can use it to pay anything. And we're going to have an $85,000 line of credit available for us to use. 85,000. Now, here's the thing, okay? If you've never dealt with lines of credit, I got one right here. I got you. $280,000. It's my home equity line of credit. In fact, you know what's crazy nowadays when I see this is like, this is kind of small. You know? You ever have those moments where like you got a $500 credit card and then like you think like, hey, the bank gave me a credit line increase to like $5,000 and it's like the most amazing thing, and now you have over $575,000 in lines of credit, and it's like, "That's not really that much." That's where I am right now. I'm like, "Oh, it's not that much." But I have this huge line of credit. They call it home equity line of credit. You provide collateral called home equity. They'll give you a line of credit if you got the financials to prove to back it up. And here's the most important part when it comes to lines of credit, the really most important part. Banks don't lend money to people who need it. And so many people, they just get this wrong, right? They're like, well, I'm going to get a line of credit now when I do need the money. And I'm going to tell you something, they won't lend it to you when you need the money, right? So let's go here and assume we have an $85,000 line of credit. And can we get some goats in the house? Right? Why do we have goats here? It's because we're the greatest of all time. And if you don't know anything about me, now you know. Okay. So let me take a look here. Down here, I paid off my mortgage in 2 years and 9 months. You can pause it if you don't believe me, but I really did. Where's my loan interest? All right. So let's go here and I'm going to do this, right? So the easiest debt to pay off or move into the line of credit, and we're going to assume it's free and clear, although realistically that's never going to happen because you're never going to have a free and clear line of credit when you need it. Um, is that you're gonna move these credit cards into the line of credit. All right. So how much is that? That's $80,000. So I'm gonna move $80,000 here. Okay, $80,000. And then guess what happens to these payments when the $80,000 is moved? Oh my goodness, these all go to zero. And then now we literally went from -$50 to more than $2,572.22. Can you believe it? Can I get a goat for being the greatest of all time? I don't know who else can do that. I'm the goat, right? You're the goat too. Especially if you're watching this video at odd hours of the night when I make these videos at like 12 a.m. or 2 a.m., right? So, can I get a goat? All right, so let's just go over the final step, which is to put your entire paycheck into that line of credit. You take your expenses out, and then after every single month, your balance is going to go down by $2,572.22. And I'll just go over the math that we always go over. So this is going to be +1, and then this is going to be all right. And then so to get the next month's balance is based on the previous month's balance, interest minus our cash flow, which is 2572.22. And then the interest, right? So we're going to take the average daily balance, right? That's going to be the interest. And then we're going to multiply it by 0.08, which is the interest rate. And then we divide by 12. Okay. And then all we do is copy and paste, copy and paste. And then we see that that sucker go down. So when we start off with $80,000 debt, like, OMG, what are we doing? Right? OMG. And I'm going to copy and paste. And then here, 35 months, it is all paid off, right? 35 months. Okay. And so I'm just going to do this right here. So 35 months. And then this is going to be 80K. And then this is going to be copy paste, right? And so now we got to tackle these loans. So which loans do we tackle? And in fact, I probably forgot to set up my loan calculator. So let's go ahead and set up the loan calculator. And how does this work? Well, you just type in the details: 25,000, 20,000, 6%, 3.99, 12,000, 7%, and then 200,000 at 3%. And I believe the auto loans are 5 years. Mortgage is 30 years, right? So what we do is we put in 35 months here, and then we figure, whoopsie, what the current balances are and what we also call the current cash flow index. Okay. So what we do, and if you've never heard of it, it's kind of like a ranking system. If it's a really low number, it's pretty safe to move into a line of credit. And I'll explain why. So, what does this low number mean? All it means is if you pay off the loan, you get a lot of bang for your buck, right? So, let me actually add these numbers up. This will be G2 plus G3 plus G4, right? So if I pay the 25 grand, how much do I get in my cash flow? $1,000. If I pay this huge mortgage, $187,000, how much do I get in my cash flow? Only 800. So pay off this to get $1,000 of cash flow. See what I mean? And if you don't, it will make sense if you just do these spreadsheets enough. All right, so now we're back here, and I'm going to copy and paste this. Whoopsie, that's the wrong one. All right. All right, whoopsie. All right, it's this 25 grand. I'm gonna do this here. And then we're gonna move that 25 grand here, plus 25602.63. And then guess what happens? Our cash flow increases because we paid off all these auto loans, and now it's over $3,656.79. Can you believe it? Woo! Getting hot in here, probably because I gotta turn on the air conditioner. All right, so now I'm gonna do this. So 3656.79. And then now in 43 months, right? 43 months, we're all good. We're done. No, actually, we got the mortgage. Okay. So in 43 months, let's figure out what the mortgage balance is. And actually, yeah, so now it's 43 months. And then how much debt do we pay off? So it's 80. So 80, 20, 25, 12. And how much is that? 137K. 137K. Okay. $137,000 of debt that's paid off. Okay. And then so now we just copy this and then now we just do the mortgage, right? Isn't that awesome? Like, how many minutes are we into this? 11 minutes. And we paid off our debt so quickly. Right? Like I'm like Bruce Lee speed at this. Like 11, everyone's like struggling with debt. It's like, oh, just I'll figure it out in 11 minutes. In fact, I've gotten so good. I've just all I do is like, well, I don't say I do this all day, but I could just watch someone's video now and just like say I'm struggling with debt, and like I don't even have to look at their numbers, and I could just make them up. Like the nurse who was like, I'm making good money, and like I'm struggling with credit cards, and then when I hear things like I'm only making the minimum payments and I'm doing buy now pay later loans, like, well, that's your problem, sis, or girlfriend, or sugar mama, or whatever title that you prefer. I like sugar mom because I like it when people pay things for me, even though um, I do have money, but I like the gesture. I don't know about you. Do you have that? Maybe not. Maybe, I don't know what it is. I feel like if you say you want a sugar daddy, that has like a stigma to it, but sugar mama doesn't have a stigma. So I'll say, if you want to be my sugar mama, you can be my sugar mama. All right, so let's go ahead and do this and now pay off the mortgage. So $843.21. And now what we're going to do is we're going to be here at 43 months, right? 43 months. And look at that. Look at that. This $200,000 loan, we only paid $184,000 after basically like, I don't know, 3 years and some number of months, right? And look at that, all that interest we paid is disgusting. It's incredibly disgusting. So what we're gonna do is we're just gonna overpay the mortgage. And here's the thing: at this stage, you might be like, "Hey, I got $3,656.79 in cash. I'm just gonna dump it all into the mortgage." Most people, even if they have the option, can't do that because they're socially conditioned that we need some savings. So one of the things that you can do as an alternative so that you can just dump all your income to debt, not even think about it, just moves a piece of the debt into a line of credit. Call it chunking, right? It's just a very simple strategy. And I want to show you something because a lot of people freak out about this. And let me go ahead and type in the details here. So let's see, 6,500 is our income. Our expenses is $2,000, I think, right? $2,000. All right, cool. So let's say, okay, we were stupid and we decided to get a 0% mortgage. Literally 0%. They don't give out 0% mortgages, okay? I don't think they do. But let's assume that we literally had a 0% mortgage, okay? So $200,000, $200,000, 0% for 30 years. And what's the payment amount? It's 555.56. 555.56. What is the worst thing that can happen to us if we do this velocity banking thing with an 8% line of credit? Oh my goodness, I only overpaid by 1,300, right? So you see like, okay, a lot of people are like, oh my goodness, 8%, you're crazy. And it's like, I get where you're coming from, but and there might be instances, for example, with the 0%, like, if there's a huge interest rate difference, yeah, you might overpay, okay? You might overpay. But a lot of people because they're not actively attacking their debt. They don't have an easy way to attack their debt. And once you put directly overpay with your mortgage, you can't get that money out. And then if you're not using your line of credit as your main operating account, guess what? You're now segregating your income and you're going back to the place where you started, right? So again, this is just an easy way to be able to pay it off but not really think about it, okay? Now, obviously, I don't know if I would do this with the 0% loan. Like, I don't know if I would, but, if I might. No, I'm just kidding. No, I wouldn't. But let's say I had a 3% loan, all right? So let's say this is like a 3% mortgage, right? 3%. Let me go in here. 3%. 843.21. 843.21. Okay? So now here it's four years, and I paid 13 grand of interest. Now you tell me how many people you know. Again, we're just doing small chunks. $8,000 in this case. It doesn't have to be 8,000. Maybe we just do 7,000. It's probably reduced a little bit. Let me just check. Yeah, just a little bit, right? 8,000, 7,000. It doesn't even matter. All right, 4 years. Okay. 4 years. And then we paid the whole thing off. Now, do you know anybody who's paid off their mortgage in 4 years? I always hear 5 to 7, 5 to 10. When I do these demonstrations, it's always four, it's always usually like 3 to 4, right? Isn't that crazy? But the most important thing about this is we have to pay the debt off in the right order. Okay. Let's pay it off in the right order. And so now what we're going to do is I'm going to do this 43 divided by 12 plus 4, right? And that's 7.58 years till the debt is paid off. And that's just all of our debt. So 7.5 years debt free, and we are now the GOAT, right? That's why you came to Velocity Banking Camp for, to be the GOAT, the debt free GOAT, right? You're going to be the debt free GOAT. Can you believe it? It's easy debt payoff Velocity Banking Camp. And this is where the type of camp where the trees just grow money, right? You ever seen money trees? I have with Excel sheets, not in real life though. But yeah. Okay. So yeah, that's it for today. You see how easy that was? Oh my goodness. I could do this all day. I'm just quoting Captain America, right? And he's like, yeah, yeah. He was like sick of his catchphrase by the end of like end games, like, yeah, yeah, I know, I know, I know. Okay. All right. Well, that's it for today, folks. This is Korean Atlanta Mentorship. Have a great day, and we'll see you on the next video.